Okay.
All righty. There we go.
Well, muting isn't that bothersome or not muting, because if we hear babies or cute dogs, I think that makes life better in a pandemic. So, great. Well, thanks for taking time out of your evening to join us. It's self-evident, we are trying to build this knowledge series program where we just have one topic a month that we present just to give some value add for information that might help you. It's not all portfolio strategy. I think, Dave, next month we're doing a college funding and how not to be taken advantage of by the man, which for me today is Mount Holyoke. But anyway, so this will be relatively brief, and when I'm finished, then we would certainly entertain any questions. It's possible I won't ask the unnamed person or persons to identify themselves, but it's possible that among our clients we have at least one, maybe two biotechnology PhD wunderkinds on the phone. So I won't say anything that I can't back up, but if any experts in the healthcare field want to opine on some of the things we're talking about, that would be cool as well. So just let me get my notes. When the market goes through a bust then boom cycle, and today a little bit of a mini bust, but overdue. When the market goes through a bust then boom cycle, investors are left wondering how much of this recovery is authentic and deserving versus how much is temporary and at risk. So when on the backside of a large recovery, as we stand today, investors look to invest in sectors that are the least cyclical, so that they can lean more on or trust more the consistency of demand and the reliability of earnings going forward. So for this reason, we felt that it would be helpful to spend some time speaking about opportunities in the healthcare sector. So I want to start with just two quick disclaimers, if you don't mind, and they are the following. In general, healthcare stocks, particularly the growthier names, are richly valued. I mean, there's little in this space that could be considered cheap. But this does not lessen the appeal of existing holdings in your portfolio in the healthcare sector. And for new investable assets, it would be entirely appropriate to at least take initial positions into the healthcare space, whether you think the market's overvalued or undervalued, but then just dollar cost average into those positions when the market experiences a correction. So if I were working with a new client and it would be our emotional wish to put all the new money into the market after it had dropped, since we don't know when that is, you could take initial positions into healthcare and then just build them up at lower prices if that's what presents itself. The other disclaimer is that we are already, in our firm, we're very well allocated in healthcare. So whether it's through diversified funds, ETFs, or single stocks, in fact, I believe that, I don't know if Steve is on the call, but I believe healthcare is our largest sector exposure, slightly above technology. However, it remains a leading theme for us in 2021 and certainly beyond, as you'll see. So with that out of the way, I will start by trying to answer the question, why now? What makes investments into the healthcare sector more appealing than other sectors at this time? So, first, we believe that the demand for healthcare services and products has become much less cyclical. So now is just as timely as yesterday and just as timely as tomorrow. And this is the essential point that I made right at the top, which is that investors are now putting a premium, or should be putting a premium, on the sectors and companies for whom demand is not correlated to macro events. So at healthcare, you're set in that way. So it's the inelasticity, if you will, just to use an Econ 101, it's the inelasticity of healthcare that makes it so appealing. Second, part of the discussion of the consistency and longevity of demand in various healthcare sectors has to include two important components. One is obvious, the other not so much, but the obvious one is just the aging of our population and lifespan growing, increasing, moving further out. But the second is the growth of healthcare infrastructure in developing countries and the huge increase in GDP coming from the healthcare industry in emerging market countries. So, for example, there's a company in Hong Kong, or on the Hong Kong Exchange, named Wuxi Biologics. And Wuxi Biologics has been a very successful holding in our widely used Matthews Asia Innovation Fund. And this company operates an open tech platform for the development and commercialization of therapeutics. And so it's in the Pacific Rim. These were not opportunities that were available to us 5-6 years ago. So now with Latin America, South America, Eastern Europe, Asia moving into a more sophisticated world and building out their healthcare infrastructure, it opens up a lot more opportunity. Third, innovative technologies are making their way into many parts of the healthcare industry. That's kind of obvious, including medical devices that are making it easier for patients to manage chronic conditions and change the current standards of care. I read an interesting piece from a healthcare manager that really struck me. His name is Edward Yoon. He's the portfolio manager for the Fidelity Select Healthcare Fund. And he, in his comments, a video relating to commitments, investment commitments in healthcare, he said, "We like to invest based on the best vision of our future. We like to invest based on the best vision of our future. And we envision a time when people don't die of cancer and have access to the most current healthcare services." And I thought that was kind of profound. I mean, right now, that same philosophy, investing on the best vision of our future, is what's driving climate change investments, which we've been using and have been recently so successful. But back to healthcare. Two examples I'll give you of this innovation. First, a company called Dexcom. They provide devices to continuously monitor a diabetic's blood sugar and therefore cut down or eliminate the need for finger pricking. And their device helps track your data, which can be analyzed for better diabetic maintenance. And the second is a company called Guardian Health. And Guardian Health produces liquid biopsies to improve the way that cancer is detected and also aid in the development of cancer therapeutics. And the stock has been terrific. Next, we like to point out that innovation brings forward entrepreneurship, commercialization, if you will. And to that end, I read a really interesting stat in a report from that same Fidelity healthcare manager. Let's see if I can say this clearly. 47%, we'll just round it up to half of the 81 initial public offerings, half of the 81 IPOs during just the third quarter of 2020 were healthcare startups. Half. And I mean, the half is epic. The fact there were 50 IPOs in the third quarter is equally as epic, but with notable prominence from telehealth, telemedicine, and biotechnology. So this simply speaks to, for me, as a strategist, This simply speaks to the supply of investment opportunities going forward, and for sure, it is not slowing down. I want to speak briefly about one pocket of innovation that's particularly interesting to me, and I'm, going to make it my mission or pass that responsibility to Steve, our research guru. And it's in the area of personalized medicine. So this Edward Yoon fella, he says that currently, if given a medicine, there is less than a 50% chance that it'll work on you. So imagine products or technologies that, through a better understanding of the human genome, can manufacture a drug that works 100% of the time. And I kind of pre-admitted to you that this is a little bit above my pay grade. I don't know that stat is exactly true, but it's exciting to imagine that based on your own genetic code, you'll be able to have a customized medicine, a customized solution to whatever ails you. And if we can locate the companies that are on the front line of personalized medicine, wow, I mean, that's just crazy. The last thing I'll say about the justification of maintaining a strong commitment to healthcare in your portfolio is this. A lot of clients, and naturally, have been asking us about how to capitalize on the COVID vaccine, or we'll say how to capitalize on the COVID vaccine race, if you will. And admittedly, that's a hard thing to do. As you heard in the news, the rollout of the vaccine is extremely fragmented at best, and the Pfizers and Modernas, AstraZeneca's, J&J's of the world, they're not going to be profiting that much from the production of the vaccine. So it's not enough to say, wow, J&J just leapfrogged over everybody with a single-dose vaccine. We got to rush out and buy J&J because they've got an arrangement that they're selling these doses at cost. However, the race to a COVID vaccine has had a major impact on investment opportunity because it is causing investors to put a premium on novel drug platforms. And that, the understanding that more quickly and with more efficacy you can bring novel drugs to the market, that does open up investable opportunities. So just a quick summary, the inelasticity of demand, the fact that healthcare as a investable juggernaut is going global or is already global, innovation, commercialization, and all the companies that are coming public, and of course some very intriguing leading advancements like personalized medicine and novel drug platforms. These are collectively the reasons why we're so high on maintaining our healthcare exposure, if not during periods of correction when these things cool off, maybe even increasing that. Let me shift over to a brief discussion about these different healthcare subsectors, different sectors within the broader healthcare universe, including, just for fun or to remind you of what you may already know, a description of a few companies in each sector that well represent each niche, if you will. And I think it's safe to say that we don't have any strong conviction right at the moment that any one of these sectors is a better value at this time over another. But we do like to look at the individual sleeves separately so that we have at least a fighting chance to identify above average opportunity when it presents itself. And I'll give you a quick example, and this is a credit to Steve, being the senior trend follower. In the early stages of the pandemic, by looking at the different subsectors, we witnessed a disproportionate amount of market loss in the medical device sector because so many elective procedures were being deferred. So we took this opportunity to invest for a recovery in this space, and so far it seems to be working. So let me quickly run down this list, beginning with, of course, medical devices. So in the medical device space, you have companies like Danaher, which is a life science and diagnostic company. They produce cellular analysis, reagents, immunology. You have Dexcom, which I already mentioned is involved with diabetes management. On a totally opposite side of things, and kind of fun really, is the company Align. And Align manufactures the Invisalign orthodontics alternative that you see all over the news. That has been crazy. Abbott Labs, which of course is well known, highly diversified. They're involved in electrophysiology, cardiac vascular products. Medtronic, which manufactures and distributes products for angioplasty, cardiac implantable devices, other minimally invasive products. And then, of course, the 900-pound gorilla in medical devices is Intuitive Surgical, which makes the beloved Da Vinci machines for robotic surgery, and that's a huge, obviously a huge advancement. So that's just a little sample of medical devices. Then we have biotechnology, and most of the analysts that we read agree that we are in the golden era of biotechnology, and it's simply pulled forward by advancements in gene mapping and artificial intelligence, which target therapeutics in cancer and autoimmune, neurodegenerative diseases like Alzheimer's, just to name a few. So in the biotech space, we have, my Lord, it's unending. We have Regeneron, metastatic cutaneous cell carcinoma, colorectal cancer products. You have Vertex Pharmaceuticals, which is big into cystic fibrosis. And then a company that I learned from one of the aforementioned but unnamed biotech PhDs who might be on the call, a company called Seattle Genetics, which is now renamed Seagen, and they produce cancer therapeutics using an antibody drug conjugate technology, which helps direct the medicine right into the cell without crushing all the surrounding tissue and health. So that's just, it's just riveting, the afflictions that they're trying to address in biotechnology. Services, healthcare services, a little more tame, a little bit easier for an investment analyst to get their arms around because you don't necessarily have to be a PhD. But we have Amedisys, which has just been a phenomenal stock. You'll find it in almost every healthcare fund. Amedisys offers home health and hospice services. A new one, which is exciting, is Teladoc, one of the leading players in telemedicine, which recently merged with the company Livongo, who has sort of more holistic things having to do with weight and such. Molina is a healthcare company that provides services to low-income families and Medicaid participants. So we've got this wonderful stock result in a company that goes into rural areas and low-income urban areas to provide services to Medicaid patients. And you wouldn't think that would be all that profitable, but sadly, it's not a sector of our population that's diminishing anytime soon. United Healthcare, a managed care insurance provider. The Fidelity guy believes that there's a rising consumer engagement at hand here in which individuals are becoming more responsible for their own services and adopting things like high deductible insurance coverage, which feeds right into it, United Healthcare. And just to tease kind of the small cap emerging sector of services, there's a company out of Israel called NanoX, and NanoX is waiting for FDA approval for an innovative and cost-reducing X-ray technology. And then lastly, we have large pharma. So these are all the healthcare names that everybody knows. They've been around forever. Frankly, They have the least amount of growth at this time due to bloated cost structure and relatively sparse pipelines. But these companies like Merck and Pfizer, they have great core revenues, and as a result, they pay very high dividends, which could be appealing for a lot of clients. Plus, because the sector has lagged so much, there is a possibility of some good catch-up in stock performance. So these are all the names you know. Johnson & Johnson is kind of a catch-all, which we really like. They're even into medical devices. My son, who is a medical device engineer, works for BioSense Webster, which is a division of J&J, and they make heart ablation technology, which has really improved the lives of people who have arterial blockage and such. Eli Lilly, big in insulin. You have Zoetis, which develops, manufactures, and commercializes animal vaccines and diagnostics, as well as agricultural and livestock solutions. And that's just been a terrific investment. So that's just sort of a sampling, which just teases the imagination of what you can invest in and how advancements in healthcare can bring about strong returns. The final consideration, and the most important, frankly, in terms of creating an actual investment plan, is how best to invest in such a broad and complicated sector. So our custom, there's many ways to do it, but our custom is to pair a diversified and professionally managed healthcare fund or funds with a number of single stocks, which may offer a unique value for any number of reasons. We use professionally managed funds and ETFs because the spectrum of investment opportunities within healthcare is so broad. And because it's so broad, that also means that the opportunity cost of owning only one or two single stocks is very high. We of course don't want our clients to miss out on any spectacular growth theme, and a well-trained healthcare portfolio manager will be observant of the entire landscape on your and our behalf. There are many flavors to broadly diversified healthcare funds, and we often use more than one in order to capture a higher total return. Some managed funds emphasize the mega cap pharma companies because they want their dividend and the capacity for merger and acquisition activity to boost growth. Other funds focus on mid-cap growth stocks in this space, which deliver a higher return, but perhaps with more volatility. And finally, other healthcare sector-specific funds are very useful, such as iShares Medical Device ETF, the VanEck Biotechnology ETF, or something like the Fidelity Health Services. So oftentimes, when a portfolio is large enough, we'll employ a series of these targeted sector funds so that we can better monitor the relative performance among them and make changes when one particular subsector is leading or lagging. So sometimes we like that better than just being in the Vanguard Healthcare, which pretty much captures the whole market. As to the use of single stocks, we don't force it. We love it, but we don't force it. None of us on the Riverside Financial Group team has training in the healthcare industry. Although I'd like to get my middle son with that medical device graduate degree to work with us, but then I fear that he would expect to be paid, so I don't think that's going to happen. But there are times when we just find an exceptional value in a single stock, either because it represents a new growth or because we just learn and become educated about it, or it's very, very cheap. And in our best judgment, it's prudent to add that because it's cheaper than the whole. So, we don't want to pretend to be someone that we're not, because we don't have a PhD in pharma or bio, but sometimes single stocks become too good to pass up. We like the Vanguard Healthcare ETF. We like First Trust Alpha Healthcare ETF, which gets more of the mid-cap growth companies. We like a new portfolio manager that Steve uncovered called Eventide out of Boston, and they are a bunch of biotech PhDs, and they invest in a diversified portfolio of early-stage companies so that you can really see a lot of growth in front of you. For single stocks, we've used J&J. We love LabCorp for their stature and their role in the COVID rollout. And we like some of the more small cap opportunities as well. So there are a lot of ways to do this, and obviously this is a one-on-one discussion with clients or prospective clients as to how we would customize a healthcare allocation in your portfolio, but we feel that it's a very strong core component going forward. So I'd like to basically just end where we started, and we've run through a lot of material. It's kind of been, I'm sure, for me, a run-on sentence, but we want to make sure that no one gets left out of holding the proper allocation to healthcare. And while the subject matter is complicated, this is why we lean on professional managers to lead the way in addition to some of our single stock choices. But at the end of the day, we're committing to healthcare simply as a staple in your portfolio because of healthcare's non-cyclical nature and really the ubiquity of need. So we know when people get sick, they want the medicine, and that's a strong investable trend for the next 10, 15, 20 years. So I pledged to Dave I would keep it to under 30 minutes, and because I was goofing around, I started at 7:03, so I think I nailed that. So I'm going to leave it there well in terms of my upfront comments. So open it up to any questions that you have, please. Or comments, if anybody has any expertise that they could share. Dave, do you want to play the Jeopardy soundtrack here, just to?
Well, no, but I mean, I don't know if this is a relevant question, but what happens with COVID over the course of the year, and how does that impact any of what you talked about? In terms of sticking with a game plan or modifying a game plan, that type of thing.
Well,
how much do we pay attention to COVID?
Yeah, I mean, you reminded me of a good point, even though it's not directly on point to your question. But just because the healthcare crisis has magnified, in no way means that healthcare stocks as a group are impervious to the economic cycle. I mean, you just like today, you will see healthcare stocks correct. If people want to reprice the market lower, as they did today, they're going to reprice healthcare stocks, whether or not it's on the forefront of our economic recovery or not. I mean, these elective surgical companies like Medtronic, Boston Scientific, orthopedic companies, they'll take a hit, but that we know that that's temporary. And, we don't necessarily feel the same about a cruise line. So we know that demand will bounce back because these are important, afflictions that people have, and they need to be remedied. There are some companies that have been greatly improved by the pandemic, and certainly companies like Abbott Labs that had the fast diagnostic machine, and LabCorp and Quest that have people coming in for testing. So there are winners, sadly, out of this. But if the economy contracts because of an overall pandemic, then healthcare will contract. It's just that they'll rebound faster because of their necessity. So anything else we can address, chat about?
This is the time
Charlie,
to come off of
I think you did a good job, Charlie.
Okay, John, thanks.
So it certainly is a big field, and you could spend a year on it. But
Indeed.
You just got to hit the high points and see if you can make a couple bucks on it.
That's true.
In light of the fact that you haven't got me my 14% CDs, I think. I guess we'd all go out of business if we got those, wouldn't we?
Yeah. Yeah. So, and man, I twisted my knee in my tennis match today before I had this call. So I got to look into whomever's making the best knee replacement, because at this age, I'm breaking down. But anyway. Well,
be a little bit careful about that, Charlie. Everybody I know who's had knee replacements has regretted it.
Oh, really?
Yep.
Huh. Well, then we need to push some advancement. I mean, actually, that medical device son did a summer internship. I don't remember the name, with a company out northwest of Boston that made customized knee replacement stuff where it would mold exactly to your configuration so that you didn't have the friction and things. And I don't know how that's going, but
well,
yeah, okay.
If I may interject, I am a happy knee and hip replacement survivor.
There you go.
It's Jan, your hyperactive windsurfing, surfing, hiking person, and I had they've come so far with knee replacements. When I first came in to the doctor's office, I told him that I wanted the triathlete knee. And he said, well, actually, we're going to give you the Journey knee for the active woman. And it was a perfect fit. I mean, it was completely seamless. Even my physical therapist said she'd never seen such a perfect match for my body structure. So they've come a long way.
Well,
and that's made with Birmingham steel.
There you go. Maybe you can hook up with Steve Austin now that you're so bionically capable. Yeah. Yeah, very good point. Well, folks, a pleasure to talk to you and whomever's on the call. And again, next month we're doing a how to finance college, and then after that in March we're having a conversation about how to use online tools for your financial planning, centering most around irs.gov, socialsecurity.org, and all of these organizations that track your money and your benefits and things like that. So pass it on. Thanks for your time. And call us if you want to talk about healthcare in your portfolio. We'd love to have that discussion. So.
All right.
Okay.
Great talk,
Thanks,
Charlie.
everybody.
Thanks.
You as well.
Thank you.
All righty.
Charlie.
Take care. Bye-bye now.
Bye-bye.
Take care.